What's up, everybody? Welcome to today's episode of Grant and Daniel Teach Me Something, whatever this new format is. We really appreciate you guys being here. So we're going to be talking about right now at the bottom of the market, what happens, what can you do to acquire and sell to make that long-term generational wealth. We all know that you can get quick cash grabs through things like wholesaling and flips, which is okay. But as Daniel so eloquently put it, you can't hand your wholesale contract down to your grandchildren. So how do we make sure that your grandkids go to a good school? Stick with us. We'll talk about it on the other side. And we're back again. This is a high quality production we got going on here. What's up, Daniel Moore?
Not much, man. I've been sick as all hell for the past week, man. Like, my kids got a bug, and it's just gone through the whole house, man.
Oh, yeah,
so
I
I'm
can
still
hear
kind of congested and just not feeling all that great today. So
yeah.
How about you? I haven't seen you in like 6 years.
I know. I missed out last week. Going out to Michigan to write up a partnership that I'm just extremely excited about. So
is the one we were just discussing?
Yeah.
That's awesome. Do you want to talk about that at all?
Yeah, absolutely. So, I've talked about a lot of times, right, the importance of a visionary and integrator relationship. And guys, so I partnered up with Ronnie Walker. He's now half owner of CreativeCashflow.com, and we are 50-50 in property acquisitions as well. But this guy's just a beast in the integrator side. And I mean, we literally Thursday decided, yeah, we're going to do this. By the end of next week, we'll have closed 7 deals into this new partnership.
That's
and that is the value of having a good visionary and integrator relationship. So we'll have a lot more to offer you guys on lead gen and transactional stuff from my end because of that relationship and showing you what's going on there, and a lot more capability in JVing with you. So if you're interested in JVing, we can always reach out and do that. But yeah,
I'm
super
excited
pumped
for you,
about
man,
that.
because like you and Ronnie had done business together for a long time, and y'all's relationship was rock solid.
Yeah.
Like the way y'all were able to put things together. And one of the things that you talk about so much, and I love that you're actually putting it into play, is that visionary integrator role piece that we talk so much about. And what you have done with Ronnie is, this is a long distance relationship,
Yeah,
but y'all are crushing it, man. I don't have anything else to say, man. But you and Ronnie put together is an amazing deal, man.
Yeah, and I'm super pumped about that. And something to be encouraging to you guys about this too is that Ronnie was actually one of my first students. Ronnie had gotten into the wholesaling side. We got a relationship. I trained him how to do the creative financing stuff, and then I brought him in as a triple equity guy.
Can I throw some questions in that, because I vaguely remember you saw a bandit sign trying to sell a sub 2 deal.
Not even trying to sell a sub 2 deal. So actually, Ronnie reminded me of this on Thursday. I didn't remember how we met, but this is a great tip for you guys. So I talk about in the creative financing, and this was down here in stage 3. So this is still applicable because we're talking about like lead generation in that period of time, and JVs are going to be huge for you if you have knowledge to leverage with somebody else's time. Absolutely use that. So yeah, like one of the things that I was doing, because I knew how to do sub 2 and that kind of stuff, is I was reaching out to wholesalers and saying, what are you doing with your low equity deals? What are you doing with the deals that you can't close on because I can and I'll pay you for them? And so what I would do is, as I'm driving around, I would just call bandit signs and say, hey, look, I'm not a seller, I'm another investor, but what are you doing with the leads that you can't close?
Right.
One of those bandit signs was Ronnie. Brought Ronnie in, trained him how to do the long-term stuff. One of the things y'all may not know is that when I was doing the 5, 10, 15 deals a month, that true volume was coming from having Ronnie there. And it took me a couple of years after buying him out to realize that visionary integrator relationship was what brought that massive volume. So yeah, we're redoing it, man. We're getting back together, and it's going to be exciting news for you guys and for us, because it's just big volume and big opportunities.
Well, that's exciting. Like let's go ahead and push on through this. Like moving in, we discussed prior to, it's like you cannot put your assignment contract into your will. And like if you do, it's just going to be a blank piece of paper. Maybe you pass some knowledge along with it, but wholesaling is an amazing way of creating income. Wholesaling is an amazing way of getting into this industry with little to no income up front, but it's not generational wealth. If you're doing this and you're creating those cash bumps, you really need to take into consideration, what am I going to do with that income that I'm making? Because it can be great income.
Right.
But if you're wanting to become a millionaire, a multimillionaire, a generational wealth, if you're wanting to put all that stuff together, it's not going to come from wholesaling on its own. Wholesaling on its own is great. Like if you're an amazing CEO making $250,000 a year at some company or whatever you're doing, that's great. But the moment you die, that income's gone.
Right.
Like, so we have to figure out how to push that income on to the next generation.
Exactly.
And that's exactly what we're going to be talking about here. And I believe that there are times where that is an easier feat to accomplish because markets have cycles. And that's what we've talked about here for the past 3 to 4 weeks, is markets have cycles, and there are times where it's easier to feed. And that's all I'm wanting to say right now. And we're going into what we might see as a slight dip in the market. We don't know where that's going. I don't want to sit here and act like, oh, we're tanking through the ground. You better be prepared for doomsday.
Right.
All I am saying is that we have market cycles, and that different cycles have different strategies that apply. And if you understand this up front, you're prepared for no matter what happens. I'd much rather you be prepared for no matter what happens than to be sitting here saying, oh, I can only do this one strategy. And then when the market shifts against you, either you get caught in it and lose big time, like bankruptcy, jump out the window, lose, or you can say, you know what, I'm going to have to pull out of this cycle because this strategy that I like and I employ is the only one that I want to do, and it's not good for this cycle.
Right. So one of the things that I want to hit on that, and just to recap, if we want to go to the screen here, I'll show you guys this market cycle chart that we've been going off of for this past few weeks. But what we're looking at is that there's basically 6 stages to a market cycle. And in those 6 stages, we feel pretty confident, myself and all of the big players that I know feel pretty confident that we're right here. We're right at that mark moving into the early downturn. So we've spent the last couple of weeks talking about how to handle that early downturn, how to handle stage 2 was last week with the short sales.
Can I pop in a question real quick?
Yeah, please.
I feel confident as well that we're at that early downturn. I feel like that is where we're at. But what I want to make sure that we talk about for at least just a moment is, how long are we going to be there? And like, is this like, hey, everybody, next month we're turning the other direction? I don't think that's the truth. Right. I think that we do have some leadway. We do have some early indications. I do think we have contracted. We're seeing days on market moving. We're seeing months of inventory increasing. All of that to be said, I think we've got probably 12 to 24 months before we really start seeing things slide. So you've got plenty of times to prepare. Don't let this come across as like, oh no, I'm not prepared. That's why we're talking about this so early. Right. Get yourself prepared.
And to that point, there is a what's the word I'm looking for? There is time sensitivity here. Right, but we do have the earlier that you figure this stuff out that we're sharing with you now, the more time you have to execute during that downturn, right? So as you'll notice, I mean, you've heard me talking about a lot of the moves that I'm making, like I'm cashing out equity, I'm putting cash into the bank, I'm coining. I keep saying coining. What's the word I'm looking at? Papering. I'm papering up partnerships to set us up into a direction. Literally had coffee this morning at 6 a.m. With a potential acquisitions manager, because we're going to be hiring a full-time acquisitions manager now. We've got some pretty serious volume even already coming in with our leads that we need managed. We're putting things into play right now, because the earliest that you can do this, the more time you have to capture these different strategies that we're talking about. But you're absolutely right. This is probably a 12 to 18-month process to get into a full-blown where you're going to hear CNN saying, yeah, the market has shifted, right?
When you hear that, it's too late.
Right?
By the time you hear CNN talking about it, it's too late. That's why we're trying to give you a heads up, so that way you can start gathering the knowledge and resources you need to learn these strategies, so that way when the market does move, you're prepared to see it move with it.
Absolutely. So back to the graph here, we want to just point out, we've talked about stage 1 is a excellent time to get in for the sub 2s. You can go back a couple of episodes and watch that. We've talked about last week with stage 2 how you can do really well with the short sales. Still sub 2 is a great way to get in there. Really all of this right here, stage 1 through like early mid stage 4 is where your highest sub 2 possibilities are going to be.
And just to remind everybody, sub 2 is an acquisition strategy. In between stage 1, 2, and 3, and 4, you might want to consider alternate disposition strategies, because sub 2 is what we're going to use to acquire the property. But sub 2, we talked about stage 1, sub 2 wrap. I still feel confident in that. Stage 1 and stage 2, sub 2 wrap all day long. But once you hit stage 3, sub 2 wrap's still great. Take a look at the property, take a look at what you think that would look like in your portfolio long term. But you have alternate exit strategies once you start hitting stage 3 that you should consider.
So right here is what we're going to focus today on, is right at the bottom, okay? So that you can be prepared for that bottom moment. Now, this right here, this turn that we're talking about may be a few years of process. So that's why it's important. I know we're going episode by episode on each stage, but it's important to understand that like stage 1 may last a year or two. Stage 2 may last a year or two, right? Like we don't know. We don't really know. Nobody knows. I love how Thomas put it. Economists have accurately predicted 7 of the last 4 economic downturns. Nobody knows. It's the future, right? And just like he said, we don't know how bad it's going to be, but we know that there's a cycle shift, and we know that there's different ways to handle each one of those. So when we are in that bottom, again, wholesaling works. Wholesaling works in pretty much all of these. Every market is a good market as long as you know how to capitalize the top strategy for that market. And I will reiterate that in a different way. You've seen me, I can probably find the graphic here for you guys, but you've seen me pull up a graphic here previously about the different options that you have, right? You can do a flip, you can do a rental buy and hold, you can do owner financing wraps, you can do wholesaling, you can do short sales. There's all these options that you have that you can do in every market. But here's an analogy that I like to use when we're talking about that sort of thought process is that, and I use this actually in a lot of different analogies, but think about how light is light. Light is white. You got a white light, okay? It is one thing. It is a singular unit, but when you shine that into a prism, it flares out into a bunch of red, green, blue, you know, all these different
colors.
Prismatic colors. My analogy in this particular instance is that you are white light. You are a single family residential investor, and you are using Propelio to be your prism so that we can accurately break out the different opportunities that you have within the single family real estate investment strategy, and that you can know that in certain situations, if you shine a red light on a piece of paper, you're going to see much more detail than if you shine a yellow light on a piece of paper, right? I mean, think about even like, remember the old school 3D lenses?
Right.
One was red, one was blue, right? Well, in certain situations, if you had red, you're going to see one picture. If you saw blue, you're going to see another picture, but it's still all being reflected through white light, which is your single family residential investing. So what we want you to understand is that every strategy always works. You just need to know which strategies are the wisest strategy to emphasize in certain market cycles. Would you agree with how I put that?
I 110% agree. And I like the way that you mentioned that it's like white light, it hits the prism. I'd almost consider the white light, and I'm trying to use your analogy here, I would almost consider the white light to be the deal. You are the prism.
Yeah, there you go.
Once the white light hits that prism, you break it down into 7 or 8, 9, 10 different strategies that could possibly be employed, and you see which light shines the brightest, and you take that one down the right path, because every property has a strategy that works best for it. Every cycle has the right strategy for it, but every property also has the right strategy for that property. So if you're going into a property and you have a one strategy mindset, meaning that you have no array of colors in your prism, all you are is a single color, then you're going to lose a massive amount of deals. So when we come in here and we take into consideration the full spectrum, then when we take a property and we throw it through that prism, we can come out the other side knowing what to do on the exit. And you've got a really good graphic that we've got pulling up right here that kind of explains a little bit more about this. And we're going to dig in deep and start talking about stage 3 and what to do there. But let's take a look at this for a second.
Yeah, so regardless of which stage you're in, I want you to adhere to this graphic here, okay? Regardless of where you're at in this cycle, I never want you to do a retail flip unless you've acquired that deal at 0 to 75%. And I say LTV here, you know, maybe that's not the right, really basis is what I'm talking about, but I'm assuming maybe you got a 100% loan on it. But if you're in it, if your basis is from 0 to 75%, that's a solid flip. If your basis, your contract, your rehab, and everything adds up to within 75 to 80%, you can probably wholesale that out for maybe a little bit of money. You know what I mean? Like if you're in at 77 cents, maybe somebody will give you $1,000, $1,500, but you shouldn't try to flip that. That's dangerous to try and flip. Similarly, if you're in at 75 to 82 cents, that gives you an opportunity to hold long term. If you're going to do like a rental or something, it's okay for you to maybe push out a little bit longer because your profits are tomorrow money, right? Owner financing really shines when you're above that 82 cent mark, 82 to 105. And then short sales are a very specific kind of deal, which you can watch last week's episode on, which is if you're at like 105 plus, then you can get into that short sale period. What I want you guys to really pay attention to on this graphic is that you can go one way and you can't go the other way. What I mean by that is If you get a deal contracted and you're all in at 60 cents, you can retail it, wholesale it, hold it, owner finance it. Short sale is a specific thing. It has to be over 105. But on the flip side, if you get a deal in at 87 cents, you are only left with owner financing being your option.
And there's a lot of those types of opportunities out there that people miss just because they don't understand that piece of the pie.
Exactly. So as we are moving into this next cycle, as we are moving down into the stage 3, which is right at the bottom of the cycle, we need to understand that, yes, our prism is still there. Yes, we still have the option to acquire with everything. But as you put it before, we want to look at our exit strategies and we want to see what's the wisest choice. And one of the things that I love to point out on that as far as like what is the wisest choice goes is you've got to look at you. You need to look at what your situation is and what you plan on getting out of real estate investing so that you can make the best decision based on the deal and based on your needs. I've got students all the time who are like ashamed to tell me, yeah, I'm going to wholesale this one out. And I'm like, dude, that's fine. You can't buy groceries with net worth. If you need some cash right now, go get you some cash. That's your situation, and don't be ashamed of it, right?
Now, you were talking earlier about an interesting piece, and maybe we'll talk about this later, where you're taking sub-2 deals, you're creating you're almost combining 3, possibly more strategies than that. You're using a wholesale, you're using sub-2, and you're using an alternate disposition strategy. Right. So when you really start learning how to put all this on paper, you can combine it all. And I don't know if we're ready to talk about that yet, but if you want to learn how you can take off some significant income up front, man, this guy's got some interesting ways of combining all these deals together to help you out. So absolutely. I hope I didn't throw you off the track there, but man, that's a
great tease. We're going to hit that. This is how I'm going to keep you guys in it. We're going to hit that on the 3rd segment here. So what he's referring to is something that I'm internally referring to as self-assigning. And this is one of the big advantages to why I always say you need to learn every strategy, because once you fully understand every strategy, you get to start mixing and matching the benefits of all of them together to where you've got this like one like Godzilla strategy that's like freaking giving you all of the best parts of all of the best strategies and getting rid of all of the worst parts of all of the strategies that are there. So I'll tease that for the 3rd segment. So what we wanted to start off in this section was, before we go to break, we wanted to really introduce to you that, look, we have talked about a couple of different things that you can do for acquisition coming in. We want to reiterate to you that you can do all of them everywhere. And you need to decide what's best for your career and what that deal is telling you is best for it. My phrase that I tell people all the time, students of mine come in and I'll ask them, I'm like, why are you doing what you're doing? What's going on? The shock value thing that I say is, I don't care what you want. I don't care what you're doing. I care that you have a why behind your what. That's what I care about.
It really means more than just about anything. Whenever I see people that are going out there and they don't have the solid why as to what they're doing that directly applies to what they're doing, it never actually happens. Like, they might have a what they want to do, but if they're missing the why, then there's chaos. If they have the why, but they don't have the what, you just pair them with the correct what, and they'll just dominate. Absolutely. I mean, the why is so important. That's why a lot of motivational speakers talk about it. That's why a lot of the gurus talk about it. Why is probably the most important thing on the plate. Like, I think why is more important than your time, your money, and your resources. Because if you have a why, you will find the time, you will find the money, you will find the resources. Why is more important than anything, in my opinion.
And why can be extremely existential, and it can be extremely pragmatic. It can be down to the fact of, why? Because I've got a bill for $8,000, so I need to go out and do a wholesale deal so I can get some money into play. Or why it can be, hey, I want to make sure that my grandchildren go to private school, right? It can be as pragmatic or as existential as you choose it to be. So now that we've introduced that. I'm not going to lie,
I don't understand either of those words.
What we're going to do, we're going to hit a break. When we get back, we're actually going to dive into, so we've talked about some of these acquisitions. Let's talk about how these acquisitions may affect our disposition and why you may choose to do one over the other, taking a larger scale option and larger scale optic at what's happening in the overall cycle and what might choose or what might decide a better strategy for your portfolio when we notice that we're at that bottom, and it kind of opens up all the options for us. So stick around, we'll be right back.
The Propelio Academy, an all-in-one education resource for training in wholesales, subject to wraps, short sales, flips, rentals, BRRRR, property management, and more. Go to propelio.com/academy to get your scholarship today. Propelio.com. What does Propelio offer? Lead generating websites, access to true MLS comps, off-market lead lists, and deal alerts. Get them all today at Propelio.com.
Welcome. Guys, if you're enjoying the conversation that we're having, we'd really love to have some interaction with you. One of the things that, unless you are here, you don't understand, we're just staring at cameras.
We have no idea what's going on out there. It's quiet.
Right.
There's no interaction going on. One of the questions I would like to ask everybody is, if you're watching right now, do you already own rentals in your portfolio? Are you already doing subject to deals? Are you already wholesaling? Go ahead and drop in the comments what your primary strategies are that you're already employing or that you're seeking to employ. So that way we can get an idea from the crowd what levels of experience we're dealing with. Mm-hmm. And then while we're going through and while I'm giving y'all some time to bring that in here, I want to give a shout out to my kids and my wife. Like, I always do this on every show. They are my why. They are a big chunk of why I'm doing what I'm doing. Tyla, Zyla, I love you both. Y'all are amazing kiddos, and my wonderful wife, she holds the fort down every day. Man, I can't believe how much of a critical, she holds the whole puzzle together, man. Like, they are my everything. So
awesome.
That's
cool that they watch. My wife doesn't give a crap about this. I can say anything I want about my wife right now. She's the most amazing woman, though. I truly love her.
My wife watches every single one.
Yeah, I'll rub it in. It's funny. So when I quit my job and we went into real estate, I had this like in my mind. It was like, yeah, me and my wife are gonna do this. Like our first entity's name was Grannon because it's Grant and Shannon, and like, yeah, we're gonna do that. And it took me 6 months to look at her and be like, oh, you don't care about this at all. She was like, not at all. I was like, all right, this will be my thing, right? So back into it, and just as a leeway here, or as a heads up here, guys, tonight, I'm gonna be speaking at Sandra Nesbitt's like wholesaler meetup that happens. It's gonna be over there at the Quest IRA building, which is in Addison. You can look at it on Meetup. I'll try to find a link and put it in the comments here. But I'm actually going to be talking specifically on how can you structure some of the creative deals, giving you a little bit more of a what behind, because we get a little bit more time to delve into specifically structuring some of this creative strategy in this next turn of the cycle. So I'd encourage you guys to show up there if you're available.
So let's dig into stage 3.
Yeah.
Let's dig into stage 3. We have gone through stage 6, going into the early downturn. We're turning down. We go through, and what we're looking for, in my opinion, before we start transitioning to stage 3 strategies, is for there to become some support in the market. If I'm seeing the prices continuously drop, if I'm seeing them just drop, I don't want to just buy, right here and it's still dropping. I consider stage 3 to be whenever it starts doing this. We start seeing it flatten out. We're not seeing the home prices drop. We're starting to see the days on market start slowing or start contracting a little bit. We start seeing the months of inventory start pulling back a little bit. We start seeing some support from a seller, transitioning from a buyer's market to a seller's market. And what I'm saying there is like full on seller's market is the upturn. Mm-hmm. What I'm trying to see is it level out a little bit. And when we start seeing signs that the things are leveling out, that's when we should start employing the strategies that I think we're talking about right now. And what we're going to talk about, in my opinion, is the 2 strategies that I think are going to work the best at the bottom. Once we hit the bottom, lending starts coming back. Lending starts getting a little tight when we're tanking. Mm-hmm. Private capital starts getting scared while we're tanking. If you've already built some of these relationships prior to, though, you've got that private money available to you, this is where you really should start employing it. At the bottom, where I feel like you're going to win the most, is rentals and sub-2 as an acquisition, but holding them as rentals as well. Sub-2 rentals, and then rentals as in like BRRRR, your BRRRR method. The buy, rehab, buy, remodel, refinance, rent, repeat, whatever it ends up being.
Yeah,
I just totally butchered that.
It's one of those.
But it's your BRRRR method. Mm-hmm. This is where you're going to be able to have the best opportunity to get a large portfolio at the best prices ever. I don't really think it's wise. Like if we're up here at the top of stage 6, and we're talking about stage 3 down here, but if we're way up here, why am I going to want to buy at the top of the market a huge rental portfolio unless I'm planning on holding that for the next 10 to 20 years? Because if I'm up here and I buy a huge rental portfolio and the market shifts against me, I have a large portfolio of negative equity assets that I have nothing that I can do with outside of short to sell or turn around and sell on a wrap if I can even pull that off.
Right.
Because if I lose all the equity, it's like I owe 180,000 for it. It's now worth 100. It's going to be hard for me to sell that on a wrap to somebody for 180 grand.
Yeah.
So really, your only disposition strategy on that is, which is one you never want to employ as the owner, is shorting. So I'm going to wait for the bottom to hit the hit. I'm going to wait for lending to start coming back. I'm going to wait for my market to get a little tighter, and I'm going to look at this channel. What I mean by channel is if we look at the housing prices on a chart, I want to see a channel where I start hitting support. And when I start seeing that support, that's when we're going to start going out and start tailoring our acquisitions to get more heavy on sub 2 with a disposition of renting, and then rentals for BRRRR. That's where I'm at on that.
And refi is the last R in there.
Yeah,
I think that's the one we left out.
There,
Did you? So it's buy, rehab, rent, refi,
right,
and repeat if you want to put another R.
And that's the simplicity of it. That is a very common strategy. You can go out there and Google BRRRR, and you'll learn everything you need to learn about it. We've got conversations on that in the Propelio Academy, so you got resources everywhere. But short and BRRRR on stage 3, and I'm going to go through and we're going to talk. I'm going to try and really drill in on not just these are the strategies you should employ. I'm going to discuss where you should employ it. Like, I don't want to just go out there and pick up a huge rental portfolio all over the place. I really want to get into the economics of history. I want to look at history. I want to start drilling into zip codes. Which zip codes saw the highest hit last time and which ones rebounded as fast as possible? I also am looking for areas of regentrification, areas that were in the path of gentrification, areas that were in the path of development, where I can see that I have the highest probability of a very high appreciation curve. Because this is why we're doing this at stage 3. Warren Buffett said this. Warren Buffett said, I get greedy when people sell, and I sell when people get greedy. Stage 6 means sell. Stage 3 means get the greediest you can absolutely get. How can we do this with sub 2?
Well, sub 2 is something that allows you, so like one of the things that you mentioned here that's super important into the sub 2 world is that, like you said, the lending gets tight. That's what happens in a downturn, is lending gets tighter, right? So there are going to be folks that have kind of created a portfolio, created a track record during these past periods of time where private money is going to be a little bit more comfortable working with a Grant or working with a Daniel during a downturn. But if you are in stage 1 of your career, which we've seen a lot of you guys commenting on and being stage 1 or stage 2 of your career where you're kind of getting things rolling, it's going to be harder for you to convince scared money to go ahead and invest with you because you don't have the track record to prove that to them. I would recommend actually going out to the Propelio Academy, propelio.com/academy. Watch Troy Fullwood's class on notes and capital raising. I mean, that guy is amazing on capital, and he wants to work with people helping him out on that too. So that's
raised like $2 billion in capital.
More.
So $2 billion, not million. B is in billions. He has raised $2 billion.
A million seconds is 11 days. A billion seconds is 32 years. That's the difference between a million and a billion.
That's a big
difference. So so when you're going down, right, and especially when we're at the bottom and lending is tight, look at how I got into my career. I mean, we talked about this 3 weeks ago, I think, or maybe 2, about, I was a 24, 25-year-old dude that had been making $48,000 a year at a job, and I had $6,000 in my bank account whenever I quit because I cashed out my 401k. No bank is lending to me on that, but within 8 months, I was consistently buying 7, 8, 9 properties a month because I knew how to buy sub 2. So that should entice you into the understanding of subject 2 is unlimited, non-institutionalized, non-recourse money.
And for those that are still at stage 1 and may not be able to decipher what he's saying, because I used to be in the same boat, like you start using terminology that the newer people don't understand. Really, sub 2 is nothing other than somebody's got a loan on a house, they can't afford to make that payment anymore, and you just step in and say, I'm going to make that payment for you. And what that power allows you to do is unlimited funding. The funding is just permanent. Like, you've got unlimited amounts of it. And that gives you the ability to acquire and amass a portfolio when you may have limited funds of your own. Now, when we get to the bottom, we'll start talking about stage 3, and we're trying to go out there and acquire subject 2. these properties will almost always have some level of past due payments. That's one of the motivating, not always, but it is one of the motivating factors that will often allow you to just walk into someone's house and say, you know what, I know that you bought this house, but I'm going to ask you to just give it to me. I'm not going to buy it from you. You're just going to give it to me. And for giving it to me, I'm going to catch up the past due payments, and I'll make the payments for you moving forward. That is sub 2. So to do a sub 2 deal, you're going to need a little bit of cash. That's where wholesaling comes in. Wholesale something, get that 10 grand, take that 10 grand. Guess what? Go out and buy an asset.
Yep, absolutely. And I don't give the seller money typically for that, because you know the question that you'll get sometimes, and the seller will literally ask, well, what am I getting out of this? And I'll say, well, you're getting not a foreclosure. You're getting not you're getting the ability to go out and get a new loan and to go continue your life without having a massive credit failure on there, right? I mean, that's what you're getting.
We're putting a break on those late payments.
Right, and you're going to be paying their payments on time, which shows up on their credit report and helps build their credit back up, right? So there's a lot of benefits that they get to it.
When I first started mentoring under you, I'm like, all right, I'll give you $1,000. All right, I'll give you $1,500. All right, I'll give you $500. And I bring you contracts, and you're like, dude, stop it. I'm like, what do you mean stop it? It's like $500, and you're like, you don't have to, man. There's like, the benefit to what you are doing is massive, and you need to understand that in your head. And once I started clicking in my head, it's like, I guess you're right, man. We are providing a serious service to these people. And while it says like, oh, why don't you just give them $1,500? That $1,500 can mean a lot times 100 properties that are all in negative states.
And that's one of the things that you've got to be prepared for, is that if you're going to do this, take it seriously, right? So if you're buying 10 houses a month and you're putting up $2,500 per house, that's $25,000 in cash per month in expenses that you have to come up with. And that knocks out some of your exit strategies that may be available to you. So like one of the things he's talking about now is you buy in section 3, in cycle 3, sub 2, and then you can rent it to have like, you know, like his I really like how you put this, how think of flips as a 7-year flip, right? Is like you're holding it as a rental until you might be able to capture some of that equity in the future. And that's great. But one of the downsides of doing that is that rentals don't give you a large chunk of money to move into that rental. They might give you a deposit, but that's their money. You're holding basically an escrow, right? So if you gave your seller $2,500 and then you had to put $8,000 up for arrears and then you got to put another 10 into rehab, I mean, that's 20 grand on one deal. You got to really figure out your economy of scale, because as you're doing this, here's the thing, as I'm talking about 10, you guys should be able to do 4 or 5 a month with this. Anybody should be able to do 4 or 5 at the right cycle, subject to buying this way, paying attention to the ways that we've taught you how to market with the leads lists that Propelio is able to provide for you, with the education that we're giving you through these Grant Teach Me Somethings. CreativeCashflow.com can take you even to a step further if you've got more questions, that kind of thing. I do mentor, I do train on that side specifically with creative financing. You have the resources and ability to do 4 or 5 a month. That is not an issue, right? We talk about big numbers of 10 or 15 a month, and you have the ability to do that too, right? Just set your goals and push for them. But if you're doing that at scale, and you think about the dominoes that fall from that and the deposits that you might be getting in that aren't truly going to be your money to spend, that is why you need to also employ the wraps to get your down payments, and the wholesaling to get your cash to use, and the private capital to use for second liens that you can kind of back yourself into paying somebody who's got $20, $30, $40, $50, $70,000 in an IRA account to be that 20 grand that you need to catch up the house, give your seller a little bit of money if you have to, and do the rehab in it, right? You can work yourself into that, right? So private money is very important. I've talked about that a couple of times on the Grant Teach Me episodes that you can go back to. But this is how we're going to combine everything that we've learned in stage 3 and say, yeah, sub 2 is a great way to get into this, but we might exit with a wholesale. We might exit with a wrap. We may even exit with a putting it up on the retail market. You can do that, right? I'm not necessarily saying that that will be the case, but when things have flattened out, you may be able to acquire a property that somebody bought a year or so ago or a year or 2 ago and put a down payment on large enough that you might have enough equity to throw it up as is and basically wholesale it off of a sub 2, right? There is just incredible opportunity for you at that bottom. And so let's kind of compare and contrast what that difference might look like on if you were to wrap it or if you were to rent it.
Let's run and talk through that on section 3 of this, because I think that Disposition has so many different things we can do, just like when we're coming in on the acquisition. Disposition has so many things to do. I think one of the things that I'd like to, because we're almost rounding up segment 2 right here, is to finish up on the analysis of the acquisition up front. If I'm in stage 3, I don't want to hold things into my rental portfolio in a market that's not going to see appreciation. Like, am I wanting to put massive amounts of rentals into areas that, how else can I say this, have very little to no likelihood of hitting massive appreciation waves? Where I'm wanting to source all of my deals are going to be the pockets that I have studied, and I always used to reject data big time. I never was a big data guy. I was much more of just a do it and do it and do it and I'll win kind of guy. Data, come back in and start analyzing your market. Break it down. Seriously break it down by zip code, and then once you get into zip codes, even look further into it by subdivisions and say, this is where the wave of appreciation hit last time. This is where it went the fastest and the hardest. These are the areas that we're seeing massive amounts of gentrification, where we're seeing older 1920s and 30s neighborhoods all being remodeled simultaneously, bringing the values of those neighborhoods from 80,000 up to 500,000. Find those pockets in your market and then find out how to get into them or right on the outskirts of them, because as that bubble continues to grow, it will push into the next area. I think that's where you should focus almost all of your marketing and most of your efforts into doing in stage 3. Because why I am talking about this so heavily is stage 3, and we touched base on this earlier, is the beginning of a 7-year cycle for you, a 6 to 7 year cycle for you. Once I grab all of this portfolio, my goal is not to be a landlord. That is not my goal at all. My goal is to pick up inventory, and I'm just going to call it inventory. I am wanting to hold on to inventory because just like in any other retail market where I buy low and sell high, same as a Walmart, same as a Target, same as any other car dealership, anything like that, I am trying to acquire product at volume, at discount, to resell back out at retail. No difference at all in what I'm talking about right now. I am trying to acquire as much inventory as I possibly can whenever things are sitting at the bottom. But what I'm looking to find is that when it is at the bottom, I am acquiring inventory that people are going to want to buy. Like if I'm Walmart, I'm not just going out there buying anything I can possibly buy just because it's cheap. I want to buy something that I can put on a shelf and somebody's going to want to take away from me. So when I'm looking at stage 3, I'm analyzing the highest probability of appreciation in the future, but when I acquire it up front, it must be a deal. But once I've got all that put together, that's going to give me the inventory I need for stage 5. That's going to give me the inventory I need for stage 6. And I think that's what we should move to when we go into this next break.
Absolutely. And just to caveat onto that too, you know, I want to be very aware of certain things. One of which being, Daniel was not a data guy when he made all his. I was not a data guy when I made all my money. So I'm not. While I agree with him, you know, Ronnie and myself, we've already sat down and had extensive discussions of exact zip codes that we will be marketing to and pushing in different states and areas because of like, hey, did you know that this zip code in this state in the Northeast has a 1.8% rent rate? Yeah, dude, there's like 180,000 people in the whole town, but we're pushing 2% rent rates. Let's move in. You know, there is data to play in that. When you're in stage 3, you're almost, like you said, has to be a deal right now. Never buy a deal off a spec. Has to be a deal right now. But I'm going to relax a little bit on the requirement of like, you won't succeed unless you have these data analytics. You can chomp stuff up. Your numbers get bigger if you're a little bit smarter about where you're concerting your efforts, right? So yeah, we'll talk about that. Let's go to break. Whenever we get back, we're going to be discussing a little bit more about some of these dispositions, and I'm going to give you a little clue on my self-assigning strategy, which we are employing right now to do some pretty good stuff for us. So stick around and we'll talk when we get back.
The Propelio Academy, an all-in-one education resource for training in wholesales, subject to wraps, short sales, flips, rentals, BRRRR, property management, and more. Go to propelio.com/academy to get your scholarship today. Propelio.com. What does Propelio offer? Lead generating websites, access to true MLS comps, off-market lead lists, and deal alerts. Get them all today at Propelio.com.
Welcome back. Before we get going, we got a very important in-person announcement. Lynette, happy birthday.
Happy birthday. Happy birthday.
Happy birthday. Glad you're watching. Thanks for spending your birthday watching it with us. Hey, I've got an ask for you guys. If you are finding something particularly interesting as you watch this video, would you do me a favor and would you throw a timestamp out there and just tell me, you know, hey man, whatever, even if it's just something impactful, throw the timestamp out there, because we want to, again, you guys are the hero here. We want to know exactly what it is that's really becoming aha moments for you guys so that we can continue to feed the stuff that is most effective for you, right? So give us a timestamp if there's something particularly impactful for you that's good to go for.
If you're getting value out of this, can we get some thumbs up there on YouTube? For all the YouTubers watching, can we get some thumbs up? For everybody that's out there on Facebook right now, we got 50 plus people watching on Facebook right now. I've got 33 likes. Can I get all of y'all that have not liked or given us a thumbs up there on Facebook yet to kind of engage with us, just so we can see what's going on there? Like, do we have 50 people watching, or are there just 50 people that have their computer screen over off to the side? So
well, even
give
more
us some
if you
love.
count
Look
the
at that.
YouTubes.
We got a lot of people joining in on that. Keep those hearts coming. Keep those things going. It gives us some level of feedback to know that y'all are actually out there and y'all are actually listening. Because yet again, we're just talking to nothing out here. So it'd be great to see some interaction from there. But we're going to talk about disposition now, and that's where we're moving into.
So disposition, you got all kinds of options. This is the cool thing about the bottom of the market, is that you got all kinds of options. Now, for the sake of time, I think the wisest thing for us to do is to boil down into two options and talk about those, because you can basically do everything. But guys, we've got an hour show, right? So let's talk about what happens if you buy at the bottom sub 2, for instance. You could have bought with lending, you could have bought with private money, you could have bought with anything, but we're talking sub 2. And then we're going to do a comparison between, hey, I'm going to rent it or I'm going to wrap it, right? Both are valid options that have great upticks for you on the other side of that market. So let's look at what one option may have over the other option to encourage you. Now, I am glad to be sitting here in this stage of, late stage 6, early stage 1, where we get to kind of look back at our own portfolios and see how that's performed over time, because I get to kind of see how that's worked for us. Now, for me, I'll hit the wrap side, and then we'll kind of talk about the rental side, because of, like, I think I mentioned this off camera to you the other day about I ran the ARVs on all my wrap, that kind of stuff. I support, just like we said 2 or 3 weeks ago, if you are in stage 1 or stage 0.5 of your career, getting started, don't have a lot going on, rentals are dangerous, because rentals take money, vacancies can kill you, and when that vacancy is there, you just don't have the money to cover the underlying debt that you've agreed to cover. One of the most important things about Subject 2 is that you've looked at somebody in the eye and you said, I'm going to cover this payment. And even though our contracts make it to where you are personally, like I said, it's non-recourse, there's an ethical, mental thing there. You told somebody you were going to take care of this. Take care of it for them, right? Do not make it to where that doesn't work for them. So you've got to turn around and take that very seriously. If you've got renters in there and you've got vacancies and you can't cover those underlying debts for 50% of your portfolio if they all went vacant at the same time, you don't need to be renting. That's a scary place to be. I know guys that are pretty heavy in the rental market that they are seeing 24 to 29% in maintenance and repair budgets annually for the money that they're having to spend just to keep that rental afloat and in rentable space, right? So my strategy that I had employed in this last downturn was I only did sub 2 wraps. I've got a few rentals. I've got a duplex that I rent both sides of, and I had a condo down in College Station that I bought with the seller financing and then rented out. Those were the only rentals I did. I support that was the right decision for me to not do any rentals then, because I didn't have the capacity or money or time or know-how or desire to handle the vacancies and the maintenance and repair that come along with a rental. So I wrapped everything, okay? So even in the bottom, bought sub 2, wrapped it. Means I capitalize on only that equity spread that was there, okay? I do not get tax benefits like I'll pass over to Daniel to talk about here in a second. I don't get a lot of the benefits that a rental would have given me. One thing that I do get, people say, well, you don't get the appreciation. Not per se, but when you buy sub 2, you're buying and you're taking over on a loan at like 4.5% on average, and you're selling at 9.5%. What that means is, and you may be a few years into the sub 2 loan, what that translates to, your debt is being paid off much more quickly than the wrap to you. The debt coming in is being paid off way slower than the debt going out. So what that means is your net worth does still grow over time. It is more predictable of a growth, but it is not as explosive as a growth, okay? So I want to be clear in saying you still get a net worth growth by sub 2 wraps. It's just more predictable and less explosive than sub 2 rentals.
Can I try and drop that into layman's terms
Please.
as easy as possible?
Please.
When we're talking about wraps, I've got a mortgage that I'm taking payments over for. Straightforward and simple. That's sub 2. And then I turn around and sell it to somebody else with a new mortgage. So I have the original mortgage, which is a low interest mortgage, and I have a new mortgage that's a higher interest mortgage. The original mortgage gets paid down much faster than the new one that I created, and as that one is getting paid down at a much faster scale, my net worth goes up. Mm-hmm. Did I say that accurately enough?
Did. Yeah.
So that's all we're saying is that when you take it over sub 2, you got an original mortgage. When I wrap it, I get a new one at a much higher interest rate, and the original one gets paid down much faster, therefore increasing my net worth.
Exactly, because that principal equity spread, the difference between, hey, I owe Wells Fargo and I owe Wells Fargo 70, and my buyer owes me 100. You've got a $30,000 principal spread. 5 years from now, you might owe Wells Fargo 55, and your guy still owes you 98. Right, so that's kind of what I'm talking about, is your equity spread raises. I want to give a shout out to Fred Marshall tuning in from Dubai.
I was just reading that too.
That's
Dubai.
Awesome, man.
That's wild.
So that was my strategy to exit. Now, benefits. I don't have the maintenance repair, right? Benefits. Once the asset is loaded, it's loaded, and I don't have to think about it again. Because unlike a rental being an annual lease or a 2-year lease or 3-year lease, this is a 30-year lease, right? We still have vacancies. As a downside, you still have foreclosures as a downside, right? Which actually turns out to be an upside for you, but that's a discussion for another day. And then, the other side is you get a large down payment from the sale of an owner finance deal. You're getting 10% in on that. So if you don't necessarily have your private capital raised yet, or even if you do, that 10% chunk that's coming in is a significant amount of money that you get to employ back into your business to refeed your marketing campaigns and refeed your acquisitions team members, especially even if that's just you, right? So that's one way to look at it. The last point I will make about that before we move on to the rental disposition is, even when you've bought at the bottom and then you look at the top, which we've just seen, the top you can still capitalize on as being the top, because this is when money gets stupid with note purchases, with hypothecations, with all kinds of different ways that you can capitalize with partial note sales, that you can capitalize on that asset that you have, which is a note, versus how you're capitalizing on the asset that you have that may be a rental property on the other side. So that's kind of my spiel for the sub 2 wrap at the bottom of the market, especially taking into account if you're in that stage 1.
So where I would throw a flip onto that is, at the bottom, your strategies open up quite a bit, because as Warren Buffett, I keep saying this, says, when people sell, I get greedy. Well, you've seen a long cycle of people just offloading their assets. Boom, let's go, let's get these out of here. And then once I start hitting the bottom and I start seeing support, that's when I'm going to dive in, and I'm going to dive in hard. As I mentioned in the last segment, I'm talking about segmenting out your market and finding the specific areas that have the highest probability of appreciation. Well, while I'm doing my marketing, there's going to be opportunities that are coming in that are not in those pockets. And when they're not in those pockets, I go through and I look at my sheet. Well, now, whenever we start talking about trading stocks and stuff, I write my plan and I trade my plan. That's the most important piece to stock trading, is you remove the emotions, you design your plan, and you trade your plan. That is where you're going to stay safe. It's no different in real estate. My plan is these 5 zip codes. I'm going to acquire as many properties in these areas as I possibly can to hold into my inventory. Anything outside of that, guess what? I'll turn around, I'll wrap it. I'll turn around, I'll wholesale it. Because you can still wholesale at this. When you're at stage 3, all strategies pretty much work. do just about any of them. You're starting to see support come back in so you can retail it. You're starting to see support come back in so you can rehab it. You're starting seeing support come back in, so there's a lot more that you can do. But where you should really be focusing and gonna kill it is get in there and get as many rentals as you possibly can through whatever strategy you possibly can. Why? Why do I want so many rentals in stage 3? Why do I want rentals stage 3 versus stage 6? Why do I want rentals stage 3 versus stage 1 or 2? Because I've already seen the values drop as low as they're probably going to go, and that's where I start building up my inventory, because this strategy moves me forward into stage 5. Now, you mentioned rentals are going to require capital to keep them going. I need to make sure I have reserves in the bank for repairs. I need to make sure I have reserves in the bank for vacancies. I need to make sure I have reserves in the bank for all of the what ifs. We need to pair other strategies up during cycle 3. Those are going to be cash acquisition strategies. If I see an opportunity to knock out a quick 50 grand on a flip, and guess what, guys? For you that are just getting in or have only been in for the last 2 or 3 years, you're like, wow, this is difficult. Getting deals at 70 cents on the dollar is extremely difficult. That's because you're in stage 5, 6. That's where you've been. Floating around in stage 5, 6 is one of the most difficult markets to get into. That's why you see people starting to adapt their one-trick pony to apply to that market, and then you find them getting themselves crushed as the time moves forward. You have to be diverse in the strategies that you're employing. That's why I'm saying when we're down here at the bottom, we need to consume as much as we possibly can, because that rental portfolio is going to provide us with several things. We're acquiring properties at really, like, if we buy at stage 3 at 70 cents on the dollar, let's think about that. I'm gonna slow this down for a second. If I buy stage 3 at 70 cents on the dollar, and I look at the channel that this home pricing should be staying in, these prices should fluctuate within this channel moving forward, and all of a sudden I hit right down here, and I buy it at 70 cents down here, I'm buying it below my support curve. If I buy it below my support curve, but I'm looking at this as a 7-year acquisition, and I anticipate my prices, they did this, I bought here, but they start going back up here, and my intention is to dispose of them up here at the top, I didn't buy them at 70 cents on the dollar of my exit strategy. I bought these things at 30 cents on the dollar. I bought them at 40 cents on the dollar. I bought them at 70 cents at that day and time, but I have proven through historical data that the likelihood of the appreciation curve coming in and coming in strong says I actually got these assets at 30 to 40 cents on the dollar. If I have anybody out there right now that is rehabbing, if I got anybody out there that's doing any other retail strategies, how would you like to have a huge portfolio of assets at 30 cents on the dollar, 40 cents on the dollar? That is exactly why I'm talking about this is where you create generational wealth. Because if I consume hundreds of properties in stage 3, I am very well set for stage 5 and 6, where I can come through the other side and look like an absolute king. Mm-hmm. And I saw so many people go from living in the back of a Buick to having a 13, 14, 18, $45 million net worth. Those numbers I just threw out there were people I actually know, numbers that are facts. They jumped in at the right time, at the right cycle, acquired assets, and boom, came out the other side looking like absolute rock stars.
Yeah, absolutely. And you know, to that point of like holding and capturing on that top end. And guys, and you know, again, there's a lot of people watching in the stage 1 of your career, and I know a question that I always had, and it's hard to get from people, is like you mentioned capital reserves. Like, what should your capital reserves be? That's a hard question to answer. Now, one of the cool things about the owner financed wraparound side of things is that your reserves don't have to be quite as substantial necessarily, just because of the nature of the business, that kind of thing. But I will put it to you this way. The guys that I know that are doing 60 to 80 plus deals a year typically are going to be holding somewhere in the $400,000 range in their bank account cash, just so that you have a point of reference.
Let me touch on this. Let me touch on this and touch on this well. For those getting in stage 1, you are in a position where you can still win. There is no doubt about that. Your primary goal through that right there is you're going to be wholesaling. You're going to have to wholesale. Wholesaling, though, is a capital strategy. You're going to be able to create capital. If I can pull in 25 grand on a wholesale, which is not impossible to do, I take 10 to 12 of that, put it back into acquiring a sub 2 asset. That still leaves me another 10 to 12. I take 7 to 8 of that and hold it in reserves. I do that times 10, I've got 70,000 in reserves. That is not hard to do. I jumped in 2008, and at 2008, one of the worst times, we're going down. By 2010, I was sitting on about $250,000 in the bank in a downward trending cycle doing the wrong strategies. I was flipping all through 2008, 2009, 2010. One of the worst strategies I could have been doing at the time. It worked. I built up a considerable amount of income, but not the right strategy for the right cycle. Had I employed the right strategy for the right cycle, my net worth would have went further than it did. All of that to be said, though, whenever we go to Wholesaling Live here, October 4th, 5th, and 6th in Houston, Texas, if you have not signed up for Wholesaling Live yet, go out there and sign up. They've got a discount code out there right now, Propelio Live. We're not getting any kickbacks off of promoting this. Don't think if you use Propelio Live that I get paid to do that. I am telling y'all to go because you're going to have 15 powerhouse speakers that are going to be discussing their input on the current market. I think you should be there. But one of the things that I'm going to discuss while I'm at Wholesaling Live is how every single one of y'all right now that may be looking at this upcoming turn and saying, man, I wish I had a private lender. Man, I wish I had the capital to jump in on this market. Man, if I only had this. I will be speaking on Sunday there at Wholesaling Live, right there before lunch, and I'm going to be discussing to you how Propelio is going to be putting together a strategy that will allow each and every one of you that may not have the capital backing them that they wish they did to go out there and really crush it in this next downturn. I'm going to show y'all exactly how y'all can participate and not just be the bird dog, not just be the wholesaler, how you can actually participate in the assets so that you too can create generational wealth. So if you have not signed up for Wholesaling Live yet, go out there and check that out, because stage 3 is historically where the greatest transition of wealth will occur. Every Great Depression, every Great Recession across the world, hands down, has always been the greatest transfer of wealth. And the thing that allowed that wealth transfer to occur is knowledge. Prepared with the correct knowledge and the ability to strike is going to give you that opportunity. Something you have said before is a rising tide lifts all boats. That is absolutely the theory we will move forward on, but I've got to throw a caveat to that. And I think it's an important one. John F. Kennedy said that. John F. Kennedy said, a rising tide lifts all boats. If you don't have a boat, you're not getting to join. And there's a lot of y'all out there right now that might feel like you don't have the boat. Propelio is bringing the boat to you. Propelio is helping you lift the tides, and Propelio is going to make sure that you move forward along with it. With the help of CreativeCashflow.com, with the help of Grant Kemp, you've got these strategies out here that you can employ. And what I want you to know is in this next upcoming downturn, we're designing something that we have not even discussed yet, that we will be releasing in Wholesaling Live, that's going to allow each and every one of y'all win, regardless of what strategy you're in. If you are dominating out there and you're listening on this right now, I will show you how you can be a part of this. If you're just now getting into the business, I'm going to show you how you can be a part of this. Because what happened last time is Main Street and Wall Street kind of combined. Wall Street jumped out on Main Street and started consuming properties. I'm going to show y'all exactly how to become a part of that.
That's awesome. So I've been looking down for a little while to give you guys some real numbers, right? Because one of the things that Propelio and CreativeCashflow.com have dedicated to is that we're going to be real. There's too many, look at my Bentleys that I rented. There's too many smoke and mirrors going on. So we're going to be real about things. So here's a direct correlation, actual numbers behind real life situations. And I'm not going to share my spreadsheet here because I need to protect the addresses for, multiple reasons. But I've got a package that I'm doing some hypothecation for, and I've brought that up a couple of times. I'm basically pulling out equity from 14 of the properties that we bought back in 2014. It's a total package of 17 properties, but 3 of those are vacant or rentals that I have. So 14 of these were bought in the bottom-ish. I mean, 14 was actually kind of right before we turned up. Bought in 14, and I am cashing out right here at the top. Right? So exactly what we're talking about doing. That total portfolio net worth value to me is $1.47 million, okay? Had I rented them, because as part of this collateral assignment package, I went into Propelio, I comped every property for today's values as of 3 weeks ago whenever I did this, and I ran that. Had I held those as a rental, you want to guess what the total net worth value would be for me?
Probably around 2.1 million,
Yeah,
2.2 million. Okay.
$2.4 million. Okay, so I'm going to reintroduce that. Right now, those 14 properties are worth $1.47 million to me. Had I rented them instead of sold them at a wrap, because when you sell at a wrap, you can only ever capture that amount of equity, right? Whatever I sold it for, that's what it is. That's what my note is, or less. It goes down over time. The total value, not talking about net worth growth. But if I'd rented them, they would now be worth $2.4 million.
So almost $1 million in additional equity capture.
50% increase, right?
100%.
Almost 100%, yeah. Almost, so like an 80%, right? So what is $1 million? So it's $1 million over 1.4. So 1 million.
You're bringing in math. I'm not good at this kind of stuff.
A 71% increase over my current net worth had I done it that way. Now, here's the caveat. Those 14 properties, I had to search to figure out, I don't even know which properties I own anymore. That is literally how it gets with a portfolio the size that we have and with owner financing. After I fired my employees, I had this moment of, I have no idea which properties I own. No clue, because they are that much of it was a weird moment where I was like, oh, where should I go to find who owes me money? Because we've just got properties that just pay.
I remember you actually hold a note on one of my assets.
Yeah.
You have a second position lien on one of my properties. I remember you calling me up one day and be like, hey, you haven't paid your rent you haven't paid your loan this month. And I'm like, I pay it every month. It's on auto pay.
Yeah.
And you're like, can you tell me where you send it to? Because I don't know. And like my office manager is not with me right now. So like, can you tell me where you're sending the money so I can go find it? And then you can go to the office and you're like, oh, well, there's 5 checks. It's like, there it is.
There was. But there again is a benefit. I mean, that's a significant payment too.
Yeah, it's like $2,700 a month.
Yeah, $2,700 a month. But I like didn't realize for several months that it wasn't coming in because it was going to my old office address. And you know that. So all I'm getting at here is that
it's hands off.
It's hands off. Right? Everybody wants passive income and they think that that's what a rental is, and it's not.
It's nowhere close.
Nowhere close. So the trade-off here, those 14 properties over this 5-year period from 2014 to 2019 have netted, not grossed, netted approximately $180,000 to $200,000 a year of income. Okay? Those 14 properties as a rental, nowhere close to netting you $180,000 a year of income. You are playing the tomorrow game on today's money to get that trade-off. So that's where his important observation of, hey man, I'm going to say that these are the zip codes I want to be in for my rentals and hold them because they are going to, I mean, they should be income producing. You should buy it, right? Quick rules of thumb, if you're going to get money off of your rental, is you need the rent rate to be double your debt service. There's another one that I have a rental rule of thumb for, and I can't remember what that is. But that's the big one. If you want to make money on it today, you got to have your rent rate to be double the debt service, or else you just should expect to just basically break even, if not lose anything on those deals. So nowhere close to that on those 14, right? I lost the rest of my train of thought. You raised your hand. What did you want to say?
You're saying $180,000 in across 14 properties of income, and that rentals nowhere near that.
Well, you're right. I totally screwed that up. Yeah,
there's some other things to think about there, because I've still got amortization plan for me. I've got the pay down of the notes if I got 14 properties, and let's just say I'm paying down on average $8,000 a year in principal balance across 14 properties. That's $90,000 to $100,000 right there in just principal pay down. If I take another step into this and I take a look at a benefit to that, I get to throw in depreciation on top of that, because the IRS will allow me to write off phantom losses, and I do mean phantom losses against those properties because the IRS says a single family residence over the course of, I believe, 27.5 years is worth $0. We all know that's not real, but it will allow me to depreciate that. Now, whenever I turn around and sell them, I'll have to recapture all that depreciation. But if I go through and I move towards stage 6 and I take that rental portfolio, rehab it out, and I group them into packages and I turn around and sell them turnkey, which is a strategy that happens well at stage 5, stage 6, because you get stupid money out there that's looking to make 4% cap rates on single family homes. I can turn around and sell these things at full retail as a package of turnkeys, 1031 exchange those, and not have to pay back that depreciation. So the depreciation, the amortization, the inflation, it all plays in together, and it might not be as good as that.
It actually is better. I just proved myself wrong. I thought of something when you said that, that I thought you were going to go down the road of. Even on top of everything else he just said, I just realized I was using money. I did my math wrong. You actually would average out to, if you did that, you would actually average out to more on the rental side. You would actually have averaged out to $300,000 a year off of actually capturing just the equity gain that occurred and averaging that out over the previous 5 years versus how I captured my equity and counted in the cash flow to get that like 180, 200 number. So basically what it boils down to is that like I actually got to keep money every year this last year to fund the rest of my business. Right? But it was $180,000, $200,000, whereas with this, you're probably not going to keep money during that 5-year period, but if you average out your total win, you're actually making more. $300,000 averaged out, and that's not even counting the depreciation tax benefits and all the other stuff that you just counted.
Well, that's great to hear. So one of the things to say, and I think we'll have to wrap this up because we're getting towards the end, is be aware on the acquisition side that you're moving into the right areas at the right times, that you're employing the right strategy for the right time for the right property. And then whenever it comes time to dispose, that you're looking at that property as a long-term asset and how am I going to maximize my profit? If you're not sitting on massive amounts of capital, sub-2 wrap all of it. But if you are able to get and hold onto levels of capital through your cash producing strategies like rehabs and wholesalings, you get those, and you teased this earlier, and we'll go ahead and throw this in at the very end. Let's talk about how we can get some today money and employ some of these same strategies at the same time, and that'll be the end of the show for today.
Absolutely. So we're going to hammer this quick, but I do want to point out to you guys again, we give. We've got a couple of asks. One is, guys, I've got creativecashflow.com where I will dive more deeply into this stuff. We do a weekly Q&A every Monday night where I'll answer every question that comes across the table with the exception of deal analysis, because deal analysis, to do it the right way, takes 45 plus minutes. So as a single family or as a seller financing essentials member, you can go to creativecashflow.com/memberships and sign up. We go through all of that. You get online videos, you get the Q&As every Monday. Thursdays for my seller financing accelerators, or I'm sorry, my creative accelerators and my creative executives, every Thursday I do a deal analysis. Every Thursday from 10:30 to 11:30 a.m. And then we do a quarterly mastermind that is a 2 or 3 day event to really dive deep into your business. So check me out at creativecashflow.com. Do not neglect going through Propelio. If you want to be more than a hobbyist and you actually want to make some money out of this business, you need a Propelio in your corner. Propelio.com will help you with your websites, your leads lists, your CRM, your everything that you need, your Driving for Dollars app. I mean, even leads lists on cash buyers. I mean, they've got everything that you need inside of that. So please check us out there. Okay, here's the cool thing. I have a deep understanding of all these different strategies, right? We've used that before. I've told you about strategies where I mixed, 4 different strategies, 5 different strategies together to make $110,000 on a property that only had $20,000 worth of equity in it in a flip within, 12. Here's the cool thing. Every educator has their little name for their strategies. I don't know what, we're calling this internally between Ronnie and myself, we're calling this self-assigning. But Ronnie has had a successful wholesaling business going on for several years, right? I mean, he's already wholesaling out 6, 7, 8 properties a month in his wholesaling side. I have the ability to come in and fund with the capital and the capital resources that I have available on lending and private capital and that kind of thing. That being said, if you're somebody who's got money in an IRA, if I can shamelessly say, hey, we got strong and protected ways for you to place it, contact me. But here's what we're doing to self-assign. Businesses need cash to operate. That's no question to anybody, right? When you start getting too heavy into tomorrow strategies and you stop talking about today money, you start running out of capital. So one of the things that we are doing, as I calling it as self-assigning, is, hey, we'll go contract a deal at 60, we'll borrow 75, which is the equivalent of having that assignment fee of wholesaling it to somebody at 75%. So we get to capture that 15%. Let's use a $100,000 house, contracted at 60, we take out a 75% loan. So we got a $15,000 assignment fee from our lender right up front, and our lender's still in at 75 cents. Our lender still has a great LTV position, right? So that allows us to feed the marketing beast, which is $10,000+ a month easily. Feed the acquisitions team, be able to refeed into the business, and then now we have long-term debt where I will be turning around to wrap that money, selling it with owner financing with a down payment of 10% on the $100,000 mark. So that gives us more today money, and then we will be capturing the cash flow that comes in between what we owe our private money and what our wrap buyer is owing us. So we are getting the wholesale assignment fee that we would have gotten already, we're getting the down payment that we would have gotten on a wrap, and we are getting cash flow, and we are getting equity gains for net worth, all within one asset.
That's an amazing way of pairing multiple strategies together to maximize every single deal. And if all you are doing is going out there looking at every deal as a wholesale, you're not maximizing anything. And that's one of the things that we try to consistently bring to the table and show everyone that's out there watching, is that if you want to make this long term, you need to understand multiple strategies. You need to understand how to maximize your deals, because when you start maximizing your deals, you start holding on to assets, you create long-term wealth. And that is what we truly want everyone out there to do, is to obtain that long-term wealth. So all of that to be said, we're getting to the end of this segment. We're going to wrap it up. I had a couple questions pop up that I'm going to just touch base on real fast. I had someone mention, when would you employ lease options? It says, when do you all use the lease option strategy? I, being a Texas investor, do not use lease options. Lease options are possible in Texas, but they're extremely difficult, and they don't provide any benefit, in my opinion, over sub 2. So why would I go through and employ a strategy that doesn't give me the benefits of a sub 2? If I can get someone to lease option their property to me, I can probably get that exact same person to sell it to me sub 2. All of those things to take into consideration. I don't do lease options. I know that you really don't. It's prevalent across the rest of the United States. But if I can get them to give it to me on a lease option, I'm probably going to try and get the sub 2.
Yeah, and so actually part of my national push will be that I need to go out there and really start learning the ins and outs of lease options, just like I have with sub 2, to see if there's any benefits. I think, so my theory, so here's the thing, a lot of people like to employ lease options because they feel like the ability to foreclose on that house is much simpler. That's the whole point of the contract for deed / lease option thing, is that getting the house back is easier.
Two totally different strategies. Contract for deed and lease options.
Well, it's the same thought process behind both of them, right? I mean, you have a contract that says they're going to execute a certain amount of something over a certain amount of time, and then either with an option, they get to choose their option to close with discounts to principal, or with the contract for deed, it's just already employed into that. So it's like, it's still kind of, the reason I lump the two together is that the same laws that destroy contract, or the law that destroys the lease option for us in Texas is the law that was made to destroy contract for deed. So that's kind of why I lump the two together. But that being said, I will be learning a lot more about that strategy. I do not believe that, like some people think, the contract for deed or lease option gets you out of the ability to foreclose more easily because of something called a federally related mortgage that Dodd-Frank defines, and I don't think enough people pay attention to that one little section of Dodd-Frank. That's why it's beneficial to you that you're talking to a guy that's actually read Dodd-Frank, because I see those things, right? So yeah, we'll talk a little bit more on the lease option sides, but if you can use it, they can be good strategies.
And then we had another question pop up, and it's left the screen, and I can't really remember which one it was, so I'm going to go ahead and punt on that. We've gone way over our time.
For sure.
So
Let me leave you guys with one bit of knowledge, right? I met with a guy, a wholesaler, 2 or 3 weeks ago, a wholesaler / flipper, who was insistent. He wanted to meet because he appreciated the idea of the wraparound, versus just the quick cash money. But he was like, look, dude, I made $750,000 from these 30 deals this year. And, 30 deals this year, $750,000. Like, what the heck? And so my question to him was, how much money do you want to make on a monthly basis? Like, what is your goal? What's your retirement? What's your goal? 20 grand a month is what he wanted to make. The short of it is, I ran the numbers right there in front of him. That $750,000 would last him 3 years. If he never bought another house, The money he made on a cash flip and wholesale would last 3 years. Had he owner financed those same exact properties using some of these more long-term stuff, it would have been another 23 years of income at $18,000, and the down payments would have supported the $23,000 a month coming in for like the next 5 years, right? So you should understand the power of tomorrow that can be leveraged today, regardless of the market cycle that we are in. So is there anything that you want to part with before we leave?
Wholesaling Live, October 4th, 5th, and 6th. We're going to be diving in deep on exactly how you can participate for those that do not have the capital. For those that do have the capital, I'm going to show you the thought process behind what we're doing, so that way we don't have to compete with Wall Street. We can become Wall Street. And I'm going to show you all exactly how to do that at Wholesaling Live. Propelio Live is the discount code you can use. Hit that up. Much love, and have a good one, man.
See you next week.
Have a good one.